All of us are aware that there is a positive note among all the major think tanks globally projecting that India's growth rate would be around 7.5% to 8% during financial year 15-16. Of course, India has embarked on a major drive aimed at economic diplomacy also. All other major macroeconomic parameters also look on track. This coercion actually by the banks due to deteriorating asset quality and slowdown the investment activity by corporates have dampened actually the credit pickup during the financial year 14-15. Growth in bank credit by scheduled commercial banks moderated to 10.5%, and on the deposit side it moderated to 11.5% to 12% on a YOY basis. Corporates have increasingly relied on commercial paper and domestic as well as the external public issuances to meet their credit requirements. One major reason for the slow credit uptake is the stalled projects which are taking time to revive due to delays in land acquisition, coal and fuel linkages. Another reason is the lagged effect of the reforms already undertaken so far, which might take over a year or so. The government, of course, all of us are aware, has started taking several policy initiatives, including efforts to revive the stalled projects. GY is even considering actually a bankruptcy law and a separate commercial courts, which will provide some respite to the mounting bad debt problem. A serious effort is also underway to track fraudulent accounts by red flagging them and installing effective early warning signals. RBI has come out with their recent guidelines on this on 7th of May 2015. Coming to the NPA concerns, of course, it continues to be the deterioration asset quality has turned an area of continuing concern for the entire banking industry. This has been, of course, attributed to the economic slowdown, lower credit growth, and also the slowdown in the private investment. The investment-related policy log jams are yet to be sorted out fully. Besides, the pressures on the asset quality have also intensified with the significant increase in the restructured assets turning into NPA. Factors of worrying things for the entire banking industry. With the gradual improvement in the economic environment and faster resolution of the stalled projects only, one can expect that there would be a faster recovery in addressing the non-performing assets of the banking sector. Banks have started adopting, of course, in the meantime, a very, very cautious approach towards lending. This, in combination with the various measures taken by RBI to control the growing NPAs, definitely should help reduce the pace of slippages in 2015. Regarding capital infusion also, Government of India is re-examining, in fact, the entire formula, the parameters and the weightages to be attached so that all banks get their legitimate share. A number of regulatory changes have been announced by Reserve Bank of India in recent months to lend support to the banking sector. A particular significant move which I would like to mention is to allow banks to issue long-term bonds to raise funds for infrastructure and affordable housing without maintaining the SLR and the CRR. These incentives, of course, will definitely enhance the bank's ability to lend to the infrastructure sector and also enable them to mitigate to a certain extent the ALM mismatches. The priority sector lending norms again has come in handy for us to meet the priority sector norms. That is really a very positive measure. PSBs, of course, have contributed significantly in the recent Jan Dhan Yojana and also on the social security schemes. We are also on track to meet commitments under various other social sector schemes being launched by the Government of India.